Is your investment portfolio dangerously exposed right now? With gold prices nearly touching $4,400 per ounce, surging over 54% this year, why does Ray Dalio, the founder of the world's largest hedge fund, Bridgewater Associates, insist you still need 15% of your portfolio in gold? What does he know about your cash that you don't? Welcome back to Trading Key. Recently, global financial markets have been absolutely shaken by gold prices, having approached a historic ceiling of $4,400 an ounce, with year-to-date gains exceeding 54%. Everyone's asking the same question: has gold completely gone crazy? But Ray Dalio offers a completely different perspective. He publicly warns that even at these sky-high prices, every single investor still needs to allocate 15% of their capital to gold. Why? Because Dalio views the cash in our hands entirely differently than most ordinary people do. He believes most people make two fatal mistakes. They treat fiat currency as wealth rather than debt, and they treat gold as a metal rather than actual money. Today, we're diving deep into Dalio's philosophy of gold in these turbulent times. We'll explain exactly why gold is your only true wealth anchor in this era of global instability. Stick around until the end, and you won't just catch an opportunity, you'll completely change the way you think about wealth. Let's start with Dalio's most fundamental insight. Dalio believes gold's value doesn't depend on anyone's promise. It has intrinsic purchasing power, and most critically, it cannot be printed or devalued by central banks. It is essentially truly undilutable cash. In contrast, the fiat currency in our hands, what Dalio calls paper money, is fundamentally just a debt promise issued by central banks. Simply put, it's an IOU, an agreement that you can exchange it for future goods or services. Its value depends entirely on government credibility. Pay close attention. When global debt scales exceed repayment capacity, historical experience tells us there are only two outcomes. Either the debt disappears through default, or the debt devalues through money printing. Only when you truly understand this foundational logic that fiat currency is debt. Can you comprehend why gold's value is exploding in this current era of massive global debt and geopolitical chaos? Beyond this paradigm awakening, who exactly is driving gold prices higher in the market? Which major capital flows are positioning ahead of the curve? Let's examine the second core argument. Gold is becoming the second major currency. Why do we say this? Because the primary drivers of this gold rally aren't retail investors like you and me. It's the national teams, the central banks. In reality, Asian central banks, including China and India, these ultra-long-term investors, are quietly replacing US Treasuries, once considered risk-free assets, with gold reserves. Once these central banks purchase gold, they almost never sell it easily. They truly hoard it. Once this trend forms, it means the circulating gold supply in the market will gradually decrease. Let's look at the data. Year to date, gold reserves outside the United States have officially exceeded the US Treasury holdings. This is the first time since 1996. After the Bretton Woods system collapsed, gold once accounted for 75% of foreign reserves. Currently, it's only around 30%. This trend fundamentally represents a challenge to the dollar's credibility and a pursuit of global asset certainty. Imagine this. If even national teams don't trust US Treasuries anymore, where can ordinary people safely park their money? Since everyone is searching for safe haven tools, couldn't TIPS, silver, or those red-hot AI tech stocks replace gold's safe haven function? How does Dalio refute these alternatives? Before we continue, be sure to give this video a like. Now, you might ask, why must it be gold specifically? Dalio provides clear explanations. This is our third reason for allocating to gold. All the alternatives have fatal flaws. The first category is other precious metals like silver. While they can hedge inflation, they lack gold's preservation and stability across countless economic cycles. Frankly, their industrial demand is broader, making their safe haven properties less pure. The second category is Treasury Inflation-Protected Securities, or TIPS. While TIPS are inflation hedging tools, they're fundamentally still government bonds. During major debt crises, their performance is tied to the issuing government's credit condition. They lack gold's intrinsic value that prices independently of anyone's credit. The third category is US tech stocks, especially AI stocks. Dalio acknowledges these growth stocks contribute enormously, but he simultaneously points out that current tech stocks exhibit local bubble phenomena, Moreover, once earnings disappoint expectations, cross-investments among AI companies create even more severe concentration risk. You see, whether we're talking about traditional financial instruments or today's hottest tech assets, none are reliable when facing the ultimate test of credit and debt. Only gold is that ballast stone with definite intrinsic value that depends on no one's promise. Do you believe the claim that other precious metals, TIPS, and tech stocks are unreliable? Let us know in the comments down below. In the next section, we'll provide specific investment ratios and purchase logic for personal gold investment. Let's answer the two questions everyone cares about most. When should you buy? And why 15%? From an asset allocation perspective, Dalio's answer is this. Setting aside short-term price fluctuations, you should hold a 15% gold position. This 15% is based on historical backtesting results between gold and other major asset classes. This ratio allows your personal account to achieve optimal risk-return ratios. Why does he emphasize diversification so strongly? Because he personally experienced the painful decade of the 1970s when US stocks went nowhere. During the tech stock bubble burst and economic stagflation, US stock indices traded sideways for years while gold and oil prices soared. This painful experience taught him the necessity of asset diversification. This is why he built the all-weather multi-asset investment strategy. The portfolio's performance has withstood the test of time and cycles, earning recognition from long-term capital. Finally, regarding gold's ultimate price target this year, Morgan Stanley, Citigroup, and other top investment banks have called for long-term prices of $10,000 per ounce. Why would this happen? Remember this. An asset's market price depends on the dynamic balance between available capital scale and tradable asset quantity. Central banks continuously buy and hoard gold, causing market-circulating gold liquidity to further disappear. Moreover, gold only represents around 30% of foreign reserves. Once central banks continue pushing this ratio higher, even just slightly, it will create enormous price impact on the scarce physical gold market. In this current era, the most chaotic period in the past 100 years, geopolitical conflicts, debt crises, and currency credit collapses intertwine. Certainty is extremely precious. Gold's intrinsic value and Dalio's gold philosophy provide us ordinary investors with the most precious certainty. Do you agree that gold is the ballast stone for future personal investment portfolios? Do you believe gold will continue rising? Let us know what you think in the comments below. If you found this breakdown helpful, be sure to give this video a like and share this with a friend who might need Dalio's advice. Subscribe to Trading Key, hit that notification bell, and we'll see you in the next video.